The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello everybody and welcome to another edition of the Live Advanced Technical Analysis course. This is webinar 10. We're approaching the end of the 12 course webinar. And in today's webinar, we will be dealing and focusing on two very important subjects within the subject of technical analysis. The first one is Fibonacci. We'll probably spend the bulk of today's webinar looking at Fibonacci, and then we will provide you with an introduction to the Elliot wave process. Forex Academy is an online provider of educational facilities to traders of financial markets and cryptocurrencies. All of the content that you'll be viewing over the course of the Advanced Technical Analysis course is educational material with the purpose of introducing you to the various tools and techniques that fall under the subject of technical analysis. Hopefully, in time, you will become more adept at using these approaches and they will be then incorporated in your discipline and contribute towards an improved ability to both analyze and trade instruments in the financial marketplace. Before we continue, just a few housekeeping issues. Please feel free to ask any questions throughout the webinar. You can locate your chat box on the right-hand side of the screen. I'll obviously be able to view your questions. This is a live webinar. It is being recorded and will be placed in your members area once the webinar has concluded. At the end of today's webinar, as always, we'll be hosting an extended Q&A session. So this will give you an additional opportunity to ask further questions. It'll also provide potentially an opportunity for us to go into a much more detailed discussion on any topics that are raised, which would then be to the benefit of everybody involved in today's webinar. This week's course follows the same procedure as we have in the first two previous weeks, whereby we look at educational material on the first 3 days of the week, Monday, Tuesday, Wednesday. We'll conclude both this week and the course with the third and final workshop, which will not only look at the material that we have focused on over the previous 3 webinars, but we'll also focus on illustrating how you can employ some of the topics that we've looked at over the entire course towards building a trading strategy, as well as incorporating a more disciplined approach to the markets. In today's webinar, we will be starting off with a focus on the Fibonacci number series. We'll have an introduction and look at the properties of the series. We will illustrate what we're really trying to do with these ratios that we calculate from the number series. We will look at 3 areas of Fibonacci. The first is retracements. We'll then look at price projections, and finally a focus on what Fibonacci time projections is all about. We'll then move our attention and our focus onto the Elliot wave principle. The basic 5-wave structure will be introduced. We will then look at the impulse, the corrective phase, which are the 2 phases of a complete 5-wave structure. We will then have at least some idea and understanding of what the complete wave structure then looks like. And we will conclude the session with a focus on how you can consider applying indicators to the wave structure to provide an additional confirmation tool. So let's start off our discussion with the Fibonacci number series. Leonardo Fibonacci was an Italian mathematician who identified the number series that produces the ratios we will apply in technical analysis. It's an effective tool that assists traders in identifying potential key points on a chart. We'll show you how you can focus on applying these important pieces of information that we extract from the ratios. From an Elliott wave perspective, this approach was formulated by a gentleman who went by the name of Ralph Nelson Elliot. He developed the principles of wave structure back in the 1930s. The Elliott wave approach, too, is a powerful tool that identifies the various stages of a trend structure and identifies the emotional phase the market is likely to be in at these various key intervals. So in essence, if we can look at it another way, and we'll have a look at this later, it is really a very detailed analysis of the underlying trend in the market. Both the Fibonacci and the Elliott wave approach are closely linked and are regarded as important analytical tools. Okay, so to start off the focus on the Fibonacci number series, as we mentioned earlier, Leonardo Fibonacci, he identified the number series. And what's quite interesting about the number series is that it is a phenomena which occurs throughout nature. And the number series looks like this. Essentially what you have is that each number in the series represents the sum of the previous two numbers. So in essence, we start off with the number 1, 1 plus 1 plus 0 equals 1, 1 plus 1 equals 2, 2 plus 1 equals 3, 3 plus 2, 5, and so the number series progresses along those lines. And that is the number series that you have in front of you. What is also interesting, and we'll take a look at this very shortly, is that as the number series progresses, the ratio between two adjacent Fibonacci numbers, 8 and 13 or 34 over 55, approaches a very important ratio, 0.618, which is known as the golden mean. And you'll see very shortly how we apply both the ratios and focus on the relative importance of this particular ratio, 0.618. The sequence of numbers can be found within patterns in subjects that most likely would originally appear to be random, such as botany, biology, art, number theory, even astronomy and music. For example, if you look at the pyramids in Giza, it's interesting to note that the angles of the pyramids are at a 61.8 degree angle. Corresponds to the golden mean that we just highlighted of 0.618. Importantly for us though, we need to answer the question, well, so much for this existing in nature, how do we apply this to financial markets? First thing that we need to do is we need to understand the properties of the Fibonacci number series. Now, we will be using the reference Fn to represent any number in the Fibonacci series. If we take any number in the series and divide it by itself, understandably, we get the ratio 1. If we take any number in the series and divide it by the next number in the series, so for example, 2 divided by 3, 13 divided by 21, 34 divided by 55, as we move along the series, that ratio will converge on 0.618. If we take any number in the series and we divide it by the number 2 positions away, so 2 divided by 5, 8 divided by 21, 21 by 55, and so on, that ratio will converge on the number 0.382. If we take any number in the series and divide it by a position or by a number 3 positions away, 2 divided by 8, 13 divided by 55, and so on and so forth, that total will converge on the ratio 0.236. And these are the ratios that we apply to financial markets, and this is how they are calculated along the series. And we will show you now how we work with these particular series or these particular ratios. What I'd just like to say at this point is that even though we have this 0.236, we won't be focusing our attention too much on this ratio. It's not to say that you shouldn't be using it as a ratio. We'll focus ourselves on the 382, 61, and the 618 ratio. If you understand how to apply these, then you can simply just incorporate this additional ratio into your Fibonacci analysis and you apply these to the markets. Before we continue, however, there is one additional ratio that we need to include in our focus, and that is the midway point between 0.382 and 0.618, and that is 50%, or 0.5. So that will also mark an additional ratio that is included in the Fibonacci ratio analysis that we will look at very shortly. So to summarize before we move on, we have three ratios that we will focus our attention on. The first ratio, and the most important of all, is 0.618. We also have 0.382, which is any number in the series divided by a number 2 positions away. We then also have a third ratio, which is 0.5, the midpoint between 0.382 and 0.618. So what are we really trying to do with these ratios now that we've understood how we can calculate them? Well, firstly, if a correction or a trend reversal unfolds or is expected, these ratios can be used to predict the extent to which the prevailing trend will retrace. The ratios can also be used to project where a trend is likely or potentially likely to move to next. We can also use Fibonacci ratios to identify important future dates. These Fibonacci ratios then represent important mapping points around which potentially important technical developments are likely to occur. So we have three aspects that we will focus on. We have a retracement. In other words, if a reversal or a correction takes place where markets are likely to pull back towards. We have projections, using the ratios to project where a trend is likely to move to next. And we also have what we will see shortly, time goal days, which are important dates that are calculated applying these ratio relationships. Okay, so let's focus our attention now on retracements to start our discussion on the ratios and the use of the ratios. What you can see in the chart in front of you is a move down in price action. If we look at the highs from the very far left section of the chart down to these lows over here, the market has clearly moved in a downward direction. For something to be retraced, it obviously makes sense that we do need to have seen some kind of a directional move in the market. Once we can establish a starting point and an end point to a trend, and the market then starts to move in an opposite direction to that prior trend, any decent charting package will automatically allow you to calculate these retracement levels. You don't need to, fortunately, do them manually and then store the levels in some place. These four horizontal lines are the retracement levels that are automatically calculated against the choice of this particular high and this particular low. Our focus of attention, as we mentioned earlier, will be on the three ratios 0.382, 0.5, and 0.618. We'll just automatically calculate them to percentage levels, and that's the form that we will use when we're talking about retracement levels. So you can automatically see that once you've identified a turning point in the trend, let's for example say somewhere in this region, you can automatically calculate where, from a Fibonacci retracement perspective, the market is likely to move to if it continues to move in an upward direction. Now, what we are not suggesting is that these levels mark resistance points. They certainly could act as resistance levels. They are simply mapping points in which we will observe and monitor price action as it continues to move higher. So the first conclusion that one could draw is that if we do see price action move beyond 38.2% retracement, then there is a chance the markets will move up towards the 50% retracement level. You can see in this instance that the market finds some form of resistance at the 50% retracement and then pulls back. It once again begins to recover and breaches the 50% retracement level at this point. Our focus would then be on the potential for a move up towards the 61.8% retracement level. Now you can see in this particular instance that the market has retraced very close to the 61.8% retracement level, and we've then seen a sharp selling reaction to the market from that level, leading eventually to a fresh low below this particular point. This just highlights a very typical kind of scenario that one would potentially expect when the market has retraced to the 61.8% level. If you are of the opinion that the move down from this high to this low is a primary trend, and therefore the likelihood is that this recovery in price action is a correction, then your focus of attention in terms of highlighting a pivotal point will be the 61.8% retracement level. That would represent a healthy correction to a trend. If, however, the market does move beyond the 61.8% retracement level, then there is a greater or a growing probability that we may indeed ultimately see a full 100% retracement level all the way back to the starting point. In other words, to state this another way, everything is corrective up to the 61.8% retracement. That correction begins to establish some question marks if price action moves beyond the 61.8% retracement level. So always treat the 61.8% retracement level as a key pivot point or an important crossroads when markets are correcting a previous directional move. And this is really how we treat the 61.8% level as an important pivot point when it comes to retracements. Remember the one point that we established earlier, your focus of attention will initially be on 38.2%. If that breaks, then the market is likely to move towards 50%. If the 50% is breached, then our focus of attention moves up towards the important 61.8% level. And that is essentially how, in terms of illustrating the use of retracement levels, we apply these retracement levels. They're simply mapping points, and we're observing what price action is doing against those potential mapping points. If you arrive at the 61.8% retracement level, and for example, you see a reversal, let's just say a head and shoulders reversal develops at that point, then the overall significance of that development in price action is further heightened in terms of an important technical development establishing itself. Let's take a look at this particular example. Now you can clearly see that we have had a significant downtrend in price action. What you need to do as an analyst applying the retracement levels is firstly identify your reference high and your reference low. You can clearly identify these two extreme points as illustrated in the chart in front of you. What we can then automatically do is we can calculate our retracement levels based on the reference high and the reference low that we had selected. We have a 38.2% retracement, a 50% retracement level, and a 61.8% retracement level. You can already see, just in terms of what we're dealing with currently, that the market found resistance close to the 38.2% retracement level, This resulted in a pullback in price action, and we have more recently broken above the 38.2% retracement. That now raises the prospect of a move up towards next the 50% retracement level. If, as we've just stressed, a retracement level has been reached, what you should do is evaluate the trend condition. Is the trend, in other words, weak, developing perhaps some reversal threat, or is the trend strong, likely to extend? In other words, if it's just a correction, is the correction weak or weakening, or is it still strong and we are likely to see a continued move in an upward direction? So that is the application of retracement levels. We'll now focus or move our attention to the use of Fibonacci price projections. Now, the employment of Fibonacci price projections is done in a way whereby we need to identify a swing in price action. So we need to allow price action to provide a suitable swing that we can employ for the use of calculating these projections. And essentially, if we just look at the illustration that we have on the left-hand side, we can clearly see that the move from A through to B, B back down to C, represents a swing. What we then do is we take the vertical distance between A and B, and we calculate various ratios based off of that distance. So A minus B times 0.618 times 1 times 1.382, etc., and add that total to the point C, in other words, the start of this move higher. And that can then provide us with a number of levels in terms of which price or a trend is likely to move towards. So the difference that we are dealing with when we talk about price projections is that we are trying to establish where the trend is likely to move to next. With retracements, we are looking at where the correction or the pullback is likely to move to. So, as we just stressed, we establish the size of the swing from A through to B. Apply the Fibonacci ratios to assess potential future targets or projections. And that is calculated from the start of the move. So if we come back to the chart that we were looking at earlier when we were talking about retracement levels, we can now also apply some swing projections with respect to the move higher. Now, you'll recall that from a retracement perspective, we focused our attention on this high as our starting point and this low over here as our end point, and that calculates our retracement levels. From a price projection point of view, we need to identify the relevant reference swing high and low that we'll be using. We can illustrate that by the use of the low, the move to the first key resistance point, which results in a sell-off, and then the subsequent pullback to the third point that concludes the swing. This has been overlaid by a dotted line where we can clearly see the swing beginning at this point, up to that high over there, and then the start of the recovery following the pullback, which will identify the 3 points of the swing. We'll calculate the distance between this point and that point, calculate various Fibonacci projections, and add those totals to this low over here. Projections then represent potential objectives, if you were looking at it from a trading perspective, as well as possible levels of support and resistance. Now, we use this word support and resistance carefully because they are not seen as future support and resistance levels. They potentially could be. What we need to do, if you recall from one of the statements that we made earlier, when price arrives at either a retracement or a projection level, establish what the trend, the underlying strength of the trend is at that particular point in time. If we look, just taking one illustration based on the swing calculation or the swing references that we have applied, you can see that we can calculate a 1.618 projection, which in this instance comes in at around the 134 level. So we have simply, just as a reminder, taken this low, this high over here, taken the vertical distance in that, multiplied that total by 1.618, add it to this particular low, and that gives us this projection, the bold red line that you see in front of you. You may also want to ask yourself, do any projection levels coincide with any retracement levels? Remember that from our previous discussion, we were using retracement levels based on this high and this low. There may be an instance where these retracement levels and these projection levels coincide. If we can reinstate the three retracement levels that we looked at earlier, you can clearly see that the 1.618 projection closely corresponds to the 50% retracement level. The existence of these two levels converging around the same price level reinforces the overall significance of the 134.40 area as potentially a possible resistance level, but also should be seen as a very important chart point. In other words, we will be on the lookout for any potential reversal points if price action arrives at this level. However, if price action does ultimately penetrate both the 50% retracement and the 1.618 projection, then that should potentially be seen as an important technical development in terms of reinforcing the underlying bullish condition in the market. Remember, anything that converges on the same level reinforces the overall significance of that level. One additional piece of information that you may or may not have observed by looking at this chart is that if we look at this price action over here, we can clearly see that historically this 50% retracement level and 1.618 projection level has provided a strong area of resistance in this particular market as it was moving down. So we have three reference points at this stage. We have a retracement level, we have a projection level, and we have an area of historical resistance that all coincide around the same level. This further reinforces the significance of this point in the chart as a key chart point, potentially a resistance level, but potentially also a significant piece of information in terms of how the trend is developing if price action moves above this level. So that then is an example of how you can apply price projections. Let's take a look at another illustration. In this instance, we can focus on two swings. If we take the first swing A, B, and C, we can then calculate a 1.618 projection. We'll just simply look at one example, which is the level that you can see highlighted in the chart where the market finds initially some form of resistance. The market moves higher and continues to move in an upward direction. We can also apply the ratio from CD through to E, and we can calculate a projection level up at the point 1.618 you can see in the chart. So the two retracement levels, or rather projection levels that have been highlighted, is this level and this area over here. We can see by just monitoring price action that once we've arrived at the 1.618 projection of the swing from C, D through to E, this area provides some resistance to the market, and we see a pullback, not a steep pullback, but the market nevertheless does pull back. Eventually, it is seen to be a correction because the market finds an area of support down at this level over here and then starts to move higher. And eventually, it breaks above the 1.618 projection of the move from CD through to E. And that confirms a resumption of the uptrend. So from an analytical perspective, your evaluation of the trend is that clearly the uptrend remains intact. if we just simply apply the sequence of higher highs and higher lows to the market, we can clearly see that this trend is up. It is further reinforced in terms of the current condition in the market by the fact that the price action has now moved above an important 1.618 projection level. Therefore, for all intents and purposes, this trend should continue to move in an upward direction. We can continue to follow the trend up by establishing the key support levels. If you recall from a discussion that we had last week, an uptrend is defined through its relative support levels. These support levels represent key risk parameters as the market is moving higher. We can also establish a trend line support that further reinforces the existence of the current trend, which eventually is broken up at these levels over here. So what we're doing by illustrating these Fibonacci projections is we're incorporating this information around our analysis of price. And it clearly illustrates how these ratios can be used as important mapping points. You have a much better understanding of where price has arrived at relative to its historical activity and what the implications of these price levels might be, depending on whether the market reverses or whether the trend continues. So, to conclude then, the trend remains bullish.